Hey, and welcome back to the Real Estate Talk Podcast. Rob Keilman.
Joshua Brett.
All right. So this episode, we have a couple special guests on today. We got Juan Burgess. He's a regional director at UQAL, and he is known for breaking down the credit game for buyers, investors, and agents alike, turning credit scores from deal killers into door openers. He's a key figure in the UQAL platform. He empowers real estate professionals to leverage AI-driven loan readiness tools that help clients qualify faster, close sooner, and buy smarter. He's a voice for financial literacy. And whether he's on stage or on Instagram, Juan keeps it real about what's holding people back and how to fix it without the fluff. He's a content creator and coach, through reels, webinars, and workshop. He simplifies FICO scores, dispute strategies, credit rebuilding, and fintech tools for everyday use. We also have Mr. Jeremy Barrios. He's a local lender in the Hampton Roads area of Virginia with Movement Mortgage. My good friend and Joshua's good friend, Jeremy, JP, thanks for coming on.
Good morning. Good morning.
Good morning, fellas.
All right. So, guys, tell me what's new in the loan officer business. Because as real estate agents, we hear about high mortgage interest rates, buyers saying, I just can't afford to do it right now. Things are tough right now. Consumer credit card debt, I think I just saw surpassed 1.2 trillion nationwide. 1.32 trillion. Okay. Yeah. It keeps going up, and it's not even Christmas yet. So not only that, it's homeowners insurance. That, like in the last 10 years, that stuff is damn near doubled in some areas.
It's doubled in
over
the last
300%.
In like certain areas.
Over 300% in the state of Florida, and up 110% in the Hampton Roads area.
Yeah. And you know what? Let's just go ahead and add the layer to our young first-time home buyers and say record amounts of student loan debt. Okay.
Yep.
We're having home prices now at historic highs in a lot of areas throughout the country. I understand some markets are in correction territory and they're selling for lower, but there's some markets now still that are getting multiple offers. Despite all of these disparities and these challenges with home buyers, it's looking like, I think I was reading a tweet or an X post that only about 70% or less than 70% of people, 70% of people cannot afford to buy a house, essentially. 30% of people are in a position to do so. Saying all that doom and gloom, you guys are in the loan and credit industry. People aren't just doing ninja loans anymore, no income, no job, approved type of loans. Credit scores do matter. So having said all this, and how are you guys identifying these challenges, overcoming these, or what are you guys just seeing in the industry that's making it very difficult to get people the funding they need to get into homes?
So, not to ruin the party, but let me tell you right now, there's three things that we are seeing happening to consumer credit reports, because I personally feel, and I'm like guys like Robert, Josh, Jeremy, I really, really hope I'm wrong. I'm praying that I'm wrong. But right now, I think we are about to see an effect of consumer credit reports that's going to be worse than the pandemic. And it's got three heads, right? So the three-headed dragon, number one, we know of right now, 9.7 million people just got hit with 90 and 120-day late on their student loans. Okay, we're seeing it everywhere. It's happening nationwide. It's happening to rich and the poor, whether you graduated or not. Repayment started, whether people were notified or not notified. I always make the joke like, I can try to get a meeting with Jeremy and send him a pigeon. I try to notify them, but I don't know if he got there. And so a lot of people suddenly had their 750, 760 credit score drop to a 520. And then when they try to figure out what happened is they're getting hit with late payments on student loans. Coupled with that, and Jeremy can attest to this, Student loans rarely come in one, right? Most people have several student loans. So that's the first one. The second one, and this is the one that really scares me because it's so new and the trend doesn't look good. Buy now, pay laters are now landing on credit reports. And the problem is that a lot of people, I don't know if you saw Klarna, $136 billion in the red from January till now. Affirm. I've seen people with an $18 collection on their credit report because they didn't pay their little Affirm loan. So it's too new, but for what I've seen so far, I cannot find a benefit of using this buy now, pay laters to increase your credit score. And the third one, and this is the most recent one, so everybody heard that the CFPB at one point or another, specifically January 7th, passed a ruling trying to remove about $50 million, sorry, with a B, $50 billion of medical bills off of credit reports. So naturally, unfortunately, people kind of react on a headline without reading the entire article, so to speak, and people stop paying their medical bills. Some people couldn't pay their medical bills. So for a moment there, everybody was under the impression that they were no longer going to be on the credit report. They just reversed that rule. And so as long if the medical bill is over $500, so literally 501 penny, it's going to go back on the credit report. None of these are positive effects on the credit report for a consumer.
Well, that sounds like a lot there, JP. So I want to start and kind of preface this because like you are kind of like in a unique space and one that, myself, I like a challenge, but you have to love a challenge, I think, to be in the space that you're in. So kind of what got you started or got you into doing what you do?
Moving here. So I moved here in 1999 from Argentina, right? And I said it before and it got me in trouble, but whatever. So I get here, right? I start going to high school. I'm living the dream. I got my first job at the Olive Garden and the breast stick guy. And like, I'm noticing all these younger kids around me, right? Like driving a Mustang or whatever. And specifically, I'm thinking of one of my cousins who shall remain nameless. I'm like, dude, like I love you, but you're not that bright. How the heck do you get that car? And so he's like, oh, Brent, like you just go, and you sign a paper and they just give it to you and you make payments. And then specifically with the Latino community, a lot of people start building their credit with this thing called Royal Prestige, where you go and finance pots and pans, like ridiculous interest rates. So when I moved here, my mom is told, hey, you got to start building credit. And it's kind of like the one-eyed person leading the blind, so to speak. And then I got my first Capital One credit card. Like, Josh, I thought it was free money, brother. And then I realized it's not how it works. I'm like, okay, there's a lot to this whole credit thing, because how come some people can get the Mustang, right, and some people can't? How come Capital One at 16 is sending me a $300 credit card and some other people can't? And that's when I started going down the rabbit hole. And then once I got into, I've been in debt settlement, I've been in debt collections. Once I got here to UQAL and really just started dedicating myself to the fact that there is 28 FICO algorithms, the fact that there's other algorithms that have nothing to do with mortgage, and why is this all so accessible to some people and not to others? And then you go back to 1956, and like, in a sense, we're using the same algorithm from back then. So the FICO 2, FICO 4, FICO 5 algorithms, right? People think FICO is directly related to credit. FICO is a Fair Isaac company. It was started in the mid-1950s. They're a software company, right? Just like Microsoft tries to peddle you a new Windows every year, FICO tries to peddle you a new algorithm. And like, honestly, I just find it fascinating that a 3-digit number decides your generational wealth. Like, to me, that's nuts.
You obviously, you guys heard about that Vantage credit score thing. Curious, how is that? So let me back up for a second, just so I can understand UQAL. So UQAL, is that a software that helps people get qualified for a mortgage, essentially, that might have some credit issues? Is that
fair to say? UQAL stands on 4 pillars, right? So we call it the 4 pillars of loan readiness. Number one is going to be DTI, right?
Debt to income.
housing is unaffordable. I can tell you, Rob, a lot of times it's not that they don't have the money. A lot of times people are misallocating the money, right? So you have the joke, Starbucks, you have Grubhub, DoorDash, all this takeout. You have things like people spending $260 on their dog monthly on average, and now introduce online sports betting, right? It's so easy to throw a parlay, and so it's not that they don't have the money in some cases. It's just that it's being misallocated. So UQAL helps to address that. The other pillar is going to be your savings. So the best way to have savings is to eliminate debt. So for instance, you talked about consumer credit card debt. Our AI gives people an opportunity to set up a comprehensive plan so that they can get out from under credit card debt. And then that money goes into savings so that they can go to Germany with money ready for their down payment and closing costs, right? The number 3 pillar is going to be documents and information that need to be gathered. That's very straightforward. And number 4, of course, is going to be credit. The biggest difference is we're digitally integrated. So we're not out here writing letters or sending smoke signals to the credit bureaus to try to get things under dispute. And that's another big difference that I want to make, because you can go on Credit Karma right now and dispute anything on your report, and that's called a blanket dispute. It's very different from what we do when you're leveraging the Fair Credit Reporting Act. The ultimate goal of the UQAL platform is to help somebody that cannot qualify yet to being able to get a pre-qual and go shopping with you guys. That's what we do, no matter whether it's financial or credit. Me specifically, I lead with education, man. Like, I had a little class that we did with Jeremy, and like, the way that it was prefaced is Credit 101, the class that was never taught in school. And I love that, because I know people in the finance industry who don't know anything about credit, and there's a reason for that, right?
Well, a question about credit, because, let's say there's a Gen Z, 21 years old, 22 years old, just graduated college, or maybe it's before college. Maybe let's go back even further, because credit card, things come in the mail as soon as you turn 18 somehow. So what should somebody do? Let's say they want to be a homeowner in their early 20s, and they're going to graduate college, get some sort of job, but they need to establish some credit. What would you recommend? Because I think you mentioned something about if you want to establish credit, somebody tells you get some sort of charge account or a credit card. What would you recommend? Would it be a credit card of sorts?
So the key word that you use is establish. So let's go from that premise, right? This isn't somebody that had good credit and went down. We're establishing. Then you need to diversify your credit mix. So I will never tell somebody to go buy a car in order to establish credit. Why am I going to put somebody in debt? Instead, you need to leverage your own money, right, to be able to establish. So 3 very simple steps. Number 1, you get a secure credit card, right? Nowadays, you can take out a secure credit card, and it works very much like a debit card. You put a deposit, and you're basically making purchases and payment on your own money. The key thing with credit cards is there's so much misinformation about how much of your balance you're supposed to use. And I ask all the time, for you real estate agents, when you're talking to your buyers, your potential clients, what percentage do you tell them to use of their credit cards? And I'll hear 50, I'll hear 30, blah, blah, blah. Analytics tells us today it's 10% or less. So, hey, Joshua, here's a $10,000 line of credit, but if you use more than $1,000, you will see your score start dropping. So secure credit card and maintaining that secure credit card with revolving activity under 10%. That's number 1. Okay, that's about 30% of your credit score. Number 2, you get a self-funded installment. Think about it as a digital piggy bank where I'm gonna every month put in $50, right, for the next 2 years. There's a lot of different tools. Just, you can Google self-funded installment. I don't want to give names because none of us are getting paid by them. So it's just self-funded installment. And number 3, there's a lot of really good opportunities now to self-report rent. But the biggest thing is a lot of people do the self-reporting. The problem with that, and Jeremy can tell you, he sees this all the time, self-reporting only shows up on Experian, not all 3 bureaus, right? And for the sake of a mortgage, you need 3 scores, throw away the high, throw away the low, work with the middle. So self-funded installment, secure credit card, and self-report anything that's going to land on all 3 bureaus. You're not getting in debt. I didn't send you to spend any money. Well, maybe $200, right? And so, like, for instance, here's a little trick. If you got a teenage in the house and you don't necessarily want them to go and get that 18-year-old credit card, so I'll speak for my 16-year-old. The moment my son turns 17 years and 11 months old, I'm adding him to my Chase account because I have about 14 years of history. So the moment he turns 18, all that data goes to the 3 bureaus. The kid's going to hit the ground running with, say, 14, 15 years of history. That's a 740, bro. From day one on a 700 plus credit score.
Man, that's pretty good. Why don't more parents do that? Or maybe they just don't know. I mean, would you say this is like some of those things that most people just don't know about?
Yeah, I would have put my kid down on one of my credit cards if I knew that would like supercharge.
But notice the timing, right? So why 17 years and 11 months? Why am I going to pay an extra, annual fee for 2 years when he's not going to have that data copy and paste it, right? Because I don't want him to just start building from my account. I want my data copy and pasted into his report. So I can do it right before he turns 18. Because the people that do know are like, oh, I got my 15-year-old as an authorized user. For what? He's not going to be populating a report for another 3 years, right? And to your point, Josh, is when you and I met, right, and we were doing our little credit 101, like, you've been in the industry, bro. You've done deals on deals on deals. But there's a lot of stuff that I was saying, and you're like, wait a minute. It's not public information for a reason, right? If we're all riding around with an 800 credit score, are the banks and financial institutions going to make any money for us? No. So you open the door to the rabbit hole. Here we go.
So you're saying they need 620s and 640s?
Do you know what they call that?
Did I hear that correctly?
Do you know what they call that? There's a name for that. It's called
I see that. Why'd you
diversity.
tell us?
Financial rate diversity.
And what
the
is
market would basically not be a stable market if we didn't have 500, 600, 700, 800. We talked about credit cards that give you mileage, remember? So the 800 credit scores get the best products, get all the miles in the world, and it's not the credit card company that's giving you those miles, it's the 500 and 600 credit scores that are paying for you to have those miles.
That's so messed up. I think about it that way.
It's a game, right? And I always make the joke, like, I can go to Jeremy's kids, grab a box of Monopoly, throw it upside the head and be like, play. They're not going to be able to win. They don't know the rules. So if I open the box and I read the rules to them, well, maybe they got a chance. And I feel like that's literally what we're doing. We're out here opening the box, reading the rules about the game. That's the game you're playing. And you don't have a choice, right? Like, you never signed up to play this game anyways.
Well, let me ask you two guys, since you talked a lot about credit and, especially as it pertains to mortgage loans. But what's the number one issue that you're seeing? Like, is there like a repeating single issue that keeps people's credit scores in the lower tier that pay for people's sky miles and stuff?
I'll answer that, seeing as I take applications on a daily basis. Obviously, education is a big part of that, and educating them on why it is. I would say there's clients that fall into different buckets. The first thing is life events. Nothing's going to hit harder than life, whether that be a divorce, a death in the family, a loss of a wage earner, things like that put people behind regarding their payment history. If your payment history consists of 35-40% of your overall credit grade, that is the number one killer of credit. You can have an 800 FICO score one day, you're late 30 days on one account, you're going to lose probably 100 points or more on that account. I always tell people that, and again, Juan, correct me if I'm wrong, it's kind of like going to school or going to college or high school, and if you have, a math grade, and you have 10 assignments. Well, if you do bad on maybe 1 or 2 assignments, you can probably still have an overall average of a B, maybe a C if you did really well on the other assignments. If you only have 1 or 2 grades and you fail one, your overall grade for the class is going to be an F. the same way that credit works. If somebody has 10 credit accounts and their allocation is a good mix, and they have one account that they might have had one blemish on, you're still probably going to be satisfactory enough for us to move forward. So life events are one issue. The other issue is just a psychological one in philosophy, with spending more than what you make and not, how you said, racking up the sky miles, or you have an emergency fund account, but you still prefer to put it on your credit card. But then you're like, oh, well, the minimum payment's only $200. I want to keep my liquidity. And they don't pay the credit cards, and it just keeps stacking up for that. So the credit utilization continues to go higher than 30%. So there's tiers to it. You should be targeting for 30%. Then you should be targeting for 10%, then 6%, right? So there's certain tiers. Most people, when you're really hungry, you want to have some oodles and noodles, and you put that in the microwave, that 3 minutes is the longest 3 minutes of your life when you're really hungry. When you have late payments, and late payments are the number one killer of credit, and in our case, when loans like VA loans and FHA loans want to see a history, and in their guidelines, a history of what they considered reestablished credit, meaning, did you have any late payments within the last 12 months? Did you have any 60 or 90-day late payments in the last 24-month period, right? So you have to restart. So if I have a late payment in June of 2025, and I'm not getting an automated approval, or even if I do, depending on the situation, I might have to manually downgrade that, or that person's going to have to wait 12 months from that last late payment. They don't know, because they again, literacy of making my payment on time. They don't realize, oh, well, I paid it before the due date, or I paid it, it was 28 days late, but I paid it before the 30th day. Well, if the 30th day is at 9 p.m. and it doesn't post, or if it's on a weekend or a federal holiday and they don't process it on time, the creditor systems will auto-report, and now you're hit. And now you have a 30-day late payment. Military clients specifically, when they go on deployment and they have things on auto pay, and their credit card numbers expire, and the payments don't go through, but they're on deployment. You don't have any internet access. You're doing, everything that you're doing on deployment. That's an issue. So life situations combined with education are the top two, or the lack of education, I would say, is the top two reasons for people not qualifying. One reason that we also stated right now, the $1.3 trillion in credit card debt, that brings your overall credit score down. And then high installment debts. The average, more auto note right now is about $525 to $555 a month, right? So you have the higher installment debts. That's another huge reason for not qualifying. And then the last bucket that I would say, and I'm not trying to be funny when I say this, is some people have an habitual habit of never paying their bills on time and maxing out their credit utilization. They'll just get their credit cards, they'll make the minimum payments, they'll have 4 or 5 of those, and it'll go over, the limit. They try to catch up, but when your average median income in Hampton Roads is somewhere between 56 and 65,000, that you're a single parent household, or maybe 2 people make 60 grand, and it's a tough to, when you have kids and life and car repairs and they're just living off the credit cards. It's really hard for people to get ahead, but they pay them when they can, and it's not a priority to pay things on time and then get a budget. So by the time their rent keeps going up 15% year after year, and then you guys get that call, hey, I need to move out of my apartment, I need to go find a house, and then we have these conversations, they come over to me. Well, the way you've been living for the last 7 years, right, if we're taking a 7-year credit history, right, is not conducive to what we're looking at in the last 24-month history of getting a 2-year work history, a 2-year income history, a 2-year residential history. So the credit is a big piece there. People moving jobs and their variable income is another issue that we can always talk about, variable income and self-employment income. People want to have it both ways. They want to be an entrepreneur and they want to have their S Corp, C Corp, 1099, but they don't want to report any income on their taxes. But you can't buy a house that way. So I still think, with as much day and age, that people still getting their information from the University of Facebook with the PhD from TikTok of, buy a house with no credit, or buy a house, doesn't matter what it is, with, blah, 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 blah. Or my dad bought a house 30 years ago in 1998 when we were doing ninja loans, no job, no credit, no income, and we would just give you a house on a negative amortization type of loan, and then 7 years later, the whole $500,000 loan is due. Those things don't exist anymore. So, even though we're doing education like this, and there's podcasts like this, there's local leaders that are on social media that are giving good information, and there are still some people, unfortunately, even in the industry that's regulated, that have clickbait, that don't give them the full information, and they just try to give them half of the information. So I think, there's a lot of different variables in there, but the constants are going to be the education of financial literacy, and then the education of, this is why I don't qualify, and putting a financial plan together. That's why I love working with JP from UQAL, because it's not credit repair, it's loan readiness. Yes, they're using technology and they're a fintech company, but when I work with him and I send him a client, he understands what the loan guidelines are. He understands that what I'm trying to do on a VA loan or an FHA loan. He's working with them to get reserves in the bank. So we're working with compensating factors of, not only does your credit score need to be here, you also need to have 3 or 6 months worth of reserves in your bank account. So they're actually putting a financial plan together that whether they buy a house or not, they are in a much better financial position today to go maybe rent an apartment, at a better rate, to go get a job with better credit. Now they have money in the bank. So they're teaching them fundamental principles. You can't pay any other creditor before you pay yourself first, and I don't want to go off on a biblical tangent here, but I believe, learned the other day from JP that the reason why we have a 7-year history is because of the Bible with the 7 years with the talons and things of that nature, right? So you got to pay yourself before you pay the creditors. Get a plan together to pay off these creditors using technology to get rid of the late payments, to delete the accounts. Most people say, oh, but I paid that collection. Well, it's showing as a paid collection. Does you no good if you paid it off and we can't get it deleted and removed from your credit report. That's still bringing your credit, score down. So people having to overcome, these myths that have been embedded into them for such an extended, long period of time. And guidelines are changing. Again, we're going to talk about, JP's probably going to talk about the new Vantage 4, lending is talking about, FICO 10. Which I'm going to hit on from a lending perspective. He can talk about from a consumer perspective, because it all has to deal with risk. And guess what? When you're lending $250,000, $500,000, it's put yourself in the bank's shoes. If I have to give somebody, I love you guys, but if I don't know you're going to pay me back $100, right? Like what history, like knowing that, okay, you might have paid Robert back within 30 days, but there's, 3 years worth of history where I got history where Josh hasn't paid anybody else back. That's not going to work, right? And the banks know this because they know the models are different. So those would be the issues, and then I'll digress there for a segue wherever you guys want to take that.
Yeah, well, I was going to also ask, you talked about myths. I think when you were explaining there, what are credit repair myths? Like, I actually used the term credit repair, and Juan, you were like, no, not credit repair, credit revitalization,
loan readiness.
What?
Yeah, my thing is credit repair died on April of 2020, and I killed it.
Okay.
I love it.
Here's the thing, though. We all work in the mortgage industry in one vertical or another, right? I help people to improve their situation so they can be loan ready. Jeremy's going to get them a loan. You're going to sell them the house, right? You're going to drive them around, do that thing. We all work for one purpose, that's to get somebody into a home loan. Having good credit does not automatically get you into a home loan. So I'm going to go back to what Jeremy just said. I can have a 720, brother, but if I have a 62% DTI, all my credit cards are at 75% utilization, okay? And my savings, my rainy day savings, it's $500. I'm not getting a house. Well, but the Virginia mortgage program, you still need to have a little bit of money for closing and all of this. So
the Virginia mortgage program
is one thing.
Yeah, so just for everybody else, the Virginia mortgage program, that is our down payment assistance program in Virginia, which can be 0 to 1% down. You guys correct me if I'm wrong, but that's for every, because it's a national audience. So
yeah, but
so every state nationally has their state bond program through their state agency. Maryland is going to be, MMP, North Carolina,
so we're not special?
Colorado, Virginia. So not that we're not special. Every state does take it upon themselves to make home ownership accessible and affordable. They're all going to have their minimum credit score requirements for all intents and purposes are around the same because it's a copy, cut, paste, type of program for the most part where, it's like a 620, 49% DTI. It is in most cases 100% financing, but you do have to have 1% invested into the transaction. So 1% of the sales price invested. And in some cases, you are going to be required to have anywhere between 1 month's reserves, meaning of your principal, interest, taxes, and insurance payment. So if your principal, interest, tax, and insurance payment is, let's just make it, we wish it was $1,000, right? If the mortgage payment was $1,000 with everything in there, right, you're going to have to show an additional $1,000 for 1 month. Or if it's 3 months, then you need to show an extra $3,000. So again, that $500 in your bank account's not going to work. And a lot of those state agencies, again, are going to want to see, good credit scores, but really, again, if they're saying we can go down to a 620, they're really looking for low debt to income ratio. So again, I see it all the time. You have a 720, a 740, but and it's a double-edged sword, and we're going to get to student loan things, but you're a teacher, you went to school for 4 years, and you got, $250,000 in student loan debt, and, but it's in deferment. I still got to hold 1% to 0.5% against you, right? Because at some point over a 30-year mortgage note, your student loan is not going to be in deferment forever. Right, you might at best be able to get on an income base or an income driven repayment, but that's going to be based on your actual income. So, and that's stuff we can talk about later, but the DTIs are going to be one of the bigger things for all those state bond specific products and any other product behind that. That's going to make a huge impact on which type of loan and your affordability into getting into a home.
All right.
Yeah, I got two quick questions for JP here real quick. So the first one is, can you tell us about collections, and if you get them paid off, can you get them deleted from your credit? That's the first question. And then the second question is let's say there's a listener out there right now today that's at a 570 credit score, right? Just kind of below where they really need to be at in order to qualify for any of the loan programs that are out there that offer the down payment assistance. What are like 3 things that you would offer them as advice to do in order to get their score up to about a 620 to qualify for those programs?
Okay, let me answer the second one first.
All right.
So for anybody that's a sub, I call it a Credit Karma sub 620, okay? Jeremy's kind of winking because he knows that person ain't getting approved. And we can talk about Credit Karma in a minute. A sub 620, please get with Rob, get with Josh, mention the Real Estate Talk podcast, and we'll give you a free credit consultation here at UQAL. Literally call tell them that you saw JP and Jeremy and Josh and Rob on the podcast. We'll give you a free consultation so that you know where you are and why, okay? Don't want to do that? Cool. Best thing you can do is, again, the first thing you're going to look at is your credit card utilization. Are you at 30? Cool. Then try for 10. If you're at 50 or if you're maxed out, try for 50. Jeremy mentioned it earlier. 30% of your FICO credit score. I don't care about Credit Karma, Credit Wise, Credit Journey, Credit whatever your mom says your credit score. Don't care. What a lender says. Okay? Start working on that. That's the easiest way to recover points. The other thing that I advise is not get your credit pool constantly. I tell people, don't get your credit pool more than 6 times a year.
Isn't there like a 5-point credit hit every time you get your credit pulled? Or like a hard inquiry?
A hard inquiry can be anywhere between 2 to 5 points, depending on what you're buying, where you're buying it. So credit is not only based on the product, it's also geographical, right? And that goes to where the credit bureaus got started, TransUnion, Equifax, and Experian, depending on where you are. That's a whole other mess. So I will look at reducing inquiries, obviously put everything on autopay, and then work on getting your credit cards down. Get on YouTube. Look at the snowball approach. Dave Ramsey talks about it, okay? It's basically the easiest way to get out from credit card debt. That's how you try to recover. But again, 833-498-7825. Give us a call. Let them know that you were or you saw the podcast with Jeremy, Robert, JP, and Josh, and we'll give you a free consultation. Your first question. This is the second biggest mistake people make, thinking that they're doing the right thing, and it hurts their credit score 92% of the time. So here's why. Notice that when Jeremy was talking about how a lender's looking at credit, we called that historical data, 7 years, right? So 7 years. When you go buy a house, they're going to look at 7 years of history. If in the state of Virginia specifically, you get a collection with, let's just say, a phone company, it's for $192, and they sold it to a collection agency. The collection agency sends you a thing saying, hey, we bought your account, now you got to pay me. And you're thinking, oh man, I have a little bit of extra money, I'm going to go ahead and pay that, okay? The phone company owes you, or the collection agency in this case, owes you two things. Number one, they need to contact all 3 credit bureaus, or however many credit bureaus the account is listed on or reported to, and they have to update the balance, right? Because you paid them. So, hey, Josh paid me my $592, TransUnion, Experian, and Equifax. Go ahead and update that on Josh's report. Cool. But the other thing that Jeremy and I see, it's called the DLA, Date of Last Activity. The DLA is, when was the last time that you paid me or didn't pay me? So if you didn't pay me 2 years ago and then I sent you to collections, your DLA is 2 years ago. Technically, in 5 years, that would have come off your report naturally, right? But if you go and pay it today, they're going to update that Josh paid me today. So that means that you just created yourself a $0 collection that will sit on your credit report for the next 7 years starting today. Wow. You just created yourself a brand new collection for $0. A $0 collection and a $50,000 collection that hits the credit report the same day takes away the same amount of points.
So what should people do if they're in this situation?
The first
is there anything differently they should do?
You want to ask for a unicorn known as a letter of deletion. Hey Josh, I want to go ahead and satisfy my debt, but I need you, Mr. Creditor, Mr. Collection Agency, to provide me with a written letter stating that you will remove this or delete this from my consumer credit report, not saying that the account's been satisfied, but completely remove the trade line. I want to know where you're going to remove it from, right? Because I can be like, yeah, man, I'll remove it. From where? From TransUnion, Equifax, and Experian. And then the last thing is when? Yeah, Josh, I'll remove it from TransUnion, Equifax, and Experian. In 5 years from now. No. When? 30 days, 60 days, 90 days? Letter of deletion stating that the account will be removed or deleted. That is going to come off of all 3 bureaus. And when is it going to come off of all 3 bureaus? The reality is this. You may have 1 in 1,000 collection agencies that would actually provide that. Okay? So the other times, let's call it 90 times or 99 times, what you do is you will hire a company like mine, right? That is not only leveraging the fintech platform, but really leveraging the Fair Credit Reporting Act. It's from 1970, 169 pages. If you want to go to sleep, read it. It's great. Let me take 169 pages and make it a sentence for you guys. Everything on the consumer credit report by law has to be 100% complete, accurate, and verifiable. If any account does not meet all 3 criteria, it is to be removed from the consumer's credit report. Period.
So let me, we talked a little bit about Vantage 4.0. Is that what it's called? Mm-hmm. Okay. Vantage 4.0. It's supposedly a different, I don't know, I'm hearing it's not, it's an alternative to FICO, or is it an alternative to FICO, or is it a complementary to FICO, so to speak?
It's a competitor.
It's a competitor, and it's an alternative, different algorithm, different way of scoring, different level layer of risk. It's modeled differently.
Because what I heard about, what's interesting, they take certain things that would normally not show up in a FICO report or credit report, such as you're paying your rent, and somehow, and rent can somehow be you contribute to this Vantage score where you're just paying your bills normally, and without having to use a credit card or something. I think that's actually very interesting because I think the way to judge somebody's credit worthiness is not just do they pay debts, but do they just pay normal everyday bills? Because if you get a debt, it becomes one of your normal everyday bills. So I would think that would go to.
So let me ask
go
you a
along
question,
better.
Rob.
Yeah.
You pay your cell phone on time every month, yes?
Do I pay myself on time every
Your
month?
cell
Cell
phone.
phone.
Your cell phone.
Oh yeah. So my cell phone, yeah, of course,
Okay,
comes
what
out
about,
automatically.
your electricity
Yes,
and your water bill?
I pay all my bills on time. I'm never late.
Perfect. How come
Sometimes
none of
you're
those
right.
on your credit report giving you points for paying them on time?
No, nothing's giving me points.
Well, why not? You're paying them on time.
Well, I guess the way FICO works, it's just consumer debt, right?
Right, but if we all stop paying our electricity, wouldn't the electric company go broke?
Yep.
You would assume so.
So when do you see an electric bill in a credit report? Jeremy, when do you see an
Sir.
electric bill, a cell phone bill, any type of utilities? When does it hit the credit report?
When does it hit?
Yeah,
When it's
Collections.
late.
when you don't pay it.
When you don't
Yep.
pay it. Yep.
Collections.
So as long as I'm paying you, we're cool, but you're not benefiting me in any way, shape, or form. You're not giving me payment history. You're not adding to my credit mix. You're definitely not adding to my CCU. You're not adding to my length of history. You're not adding to any of the 5 factors that FICO has, right? But then if I don't pay you, you're gonna hit my payment history, which is 35% of my credit score. That's called a negative contract, gentlemen. A negative contract is anything that you pay on a monthly basis that is not on your credit report until the relationship turns negative. That's something that Vantage is going to pick up. A positive contract, your car loan, your motorcycle, your jet ski, your credit cards, your mortgage, anything that you pay that is helping you build credit as long as you're on time is a positive contract, right? So that's the difference between a charge-off and a collection, so that we can kill that. Because everybody's like, oh, well, I have a collection, but, I signed with Verizon. I never signed with Jefferson Capital, so I'm not going to deal with them. I'm not going to pay them. The collector bought the rights to pursue the debt, okay? Whether you sign with them or not, does not matter. You owe the money, okay? So I want to make that very, very clear because the Vantage scoring model, it's going to be looking at those kinds of things. So to Robert's point, let's just say that before V or Vantage 4.0, it's going to be looking at rental history. Well, if that person did not, in the last 12 months, right, their 12-month lease, that person did not pay on time 3 months, how is Jeremy Berrios going to take a look at that? Because it's directly related to housing, right? We don't know. We just don't know right now. The second thing is, we talked about credit card utilization being below 10%. This new algorithm has a 2% section, which seriously, dude, 2%, it's based on your balance. Not your balance to limit ratio, but just basically how much you carry. And here's the part that scares the crap out of me. And we can argue this from both sides, good or bad, right? So let me give you the rabbit hole guide side.
Let's go.
If I'm going to ask for $450,000 for a 30-year period, okay? And I'm telling Jeremy that he can only judge me based on the last 28 months, that's what we're proposing with this. Vantage does not go back 7 years. It looks at trending data. And the reality is this, guys. Go back past the last 2 years. What happened before that? We had a global pandemic. People lost their job. People lost hours. People didn't pay their credit cards. People were not able to pay their car loans. And unfortunately, a lot of people lost their home. But based on this new algorithm, all of that is water under the bridge. And the reality is that the reason we have not changed FICO is because it freaking works, right? Is it rudimentary? Yes. Is it what we know in my world, in the tech world, a dumb algorithm? Yes. What do I mean? It was given a certain set of rules. It cannot learn anything new, okay? This isn't ChatGPT or Grok that we're talking about. This is the same damn thing we've been using since 1986.
Maybe it's tried and true, but it may not apply as much as it did before. And here's what I mean by that.
No,
We talked about
100%.
earlier about the rising consumer credit card debt at 1.4 trillion. I mean, when the Fair Isaac, Newton score was created,
Fair Isaac Score Corporation, yeah.
did they have that type of consumer credit card debt at the time? Are the variables going to change about who's credit worthy or not? Or is Americans in general just more riskier now because the amount of debt people are carrying?
Ooh.
So, one, I would say more people, I hate to say it, that it's more risk. The more debt you carry, the more risk you are. That's how the scoring models are based. We're looking at you take on, you're asking for a 400, in this case, $450,000 debt for 30 years. Over the course of 30 years, based on your historical and possible trending data, they look at the best teacher and the best predictor of the future is the past, right? Always has, always will be. And that's how risk
But how far
mitigation is
back in the
always
past
looked
can
at.
you really go? Like
Well,
7
in
years,
this case, it's always going to be 7 years. And here's what the issue is going to be. They created the CFPB in 2008 to stop foreclosures and ninja loans, right? When we fast forward to a potential use of now Fannie and Freddie being able to use Vantage 4, here's the thing. It may be optional, and it's a way that they could do. You're going to have some very smart people in capital markets of all of the top lenders and wholesalers, companies that are ones that are actually funding these loans. They're going to say, it's optional. I'm not going to be an early adopter. We're going to wait and see who uses it before we transition. We had this conversation even now with FICO 10. FICO 10, you can technically use as an alternative to FICO's 5, 4, and 2 to model and base risk scoring mitigation to obtain a loan. Some lenders are using that. Here's the reason. I can count on 3 fingers the amount of lenders that are using FICO 10 and why everybody else is still using 5, 4, and 2. So even come September of this year and Q4 and Q1, you won't see the industry transition over to Vantage 4 because they're going to want to see more data of it. Because at this point, you're essentially taking somebody who would be a 550 and now they might be potentially a 700 FICO score. That layer of risk tells me that person on paper is not accurate. They're going to default. You're going to have first payment defaults and a lot of EPOs and foreclosures. And banks and government agencies such as HUD and VA and Fannie and Freddie, who insure these loans, who are the largest purchasers of these loans. And then you're talking about securitization from a mortgage-backed security standpoint. When we start talking about then playing hot potatoes with ticking time bombs, we all seen that movie, The Big Short, right? Now everyone, okay, let's play this game now, right? Let's play the game of, okay, we're going to have late and not early adopters, right, to take Vantage FICOs 4 because they know that people are not going to pay their mortgage on time. Now let's say there are some early adopters to it, and let's just say more and more people adopt to it. But now you have the MBS, which people who don't know is a mortgage-backed security. Mortgage-backed security comes in 2s. One is the mortgage servicing right, and one is the note itself. When we start pulling and creating these notes together, okay, and we start to go to sell them to Goldman Sachs, when we start to go to sell them to a Morgan Stanley, to a JP Chase Morgan, to all these institutions, right? Guess what? These then become CDOs, and these are also part of people's 401ks, investments, annuities, and stuff like that. But when they stop performing because of payment and the money flow, who's going to get caught with that time bomb from them being shit-rated bonds at this point, right? And there's no one left to, right? No one left to hit the market. Now everyone's like, oh shit, I don't want to be a first originator, first purchaser of them, nor do I want to be a player in the secondary market with these loans that have been scored with the Vantage FICO scoring system model, right? And then we revert back to FICO's 5, 4, and 2 anyway, right? So that's how it's going to work.
I got something here for you, though, Jeremy.
Hang on. That was beautiful, bro. Thank you.
But listen, if I understand V4 correctly, right, 28 months, right? How many times, Jeremy, you yourself, have you given somebody a home loan who had a short sale 2 years prior?
We're not talking about catastrophic events. One, however,
No,
here's
but listen, hear me out though, right? So if I have a short sale right now
give me a
today,
date. Hmm. You're waiting
if I
2
have a
more
short
years.
sale right now today, I've helped several people get a home that had a short sale 2 years prior today, right? So
We're not.
you're only penalizing them for 2 years on a short sale
you're
anyways.
you're looking at it. So first of all, I will always say two things can be true at the same time, right? You can have a decent credit score now, right? Because FICO's 542 say okay, and again they use that 2 year history, right? Because they're saying okay, do they have a history of reestablished credit post a major derogatory event like a foreclosure and like a short sale? So they're looking to see does they have it, and they're still taking 7 years worth of historical data. When you're taking Vantage 4, you're just saying, first of all, they're still going to want that you still they're not going to say they can no longer have. That's a non-QM product, right? They're no longer going to say he has a short sale today, tomorrow he can get a loan. That doesn't work like that. They're still going to say 2 years post derogatory. But they're still going to take in this model, you're still taking in the 28 months, and even in the other model, you're still taking in the 7 year history. The score is just going to look different, but guess what? If you don't have a history of reestablished credit and meeting other compensating factors, those people who I have personally helped post bankruptcy and short sale, because on Fannie Freddie, those are 4 years anyway, and 7 years after delinquency, again, it's in the guidelines, 7 and 4 years respectively, and in certain cases, 2 years on FHA and VA for short sales and stuff like that. We're still taking that with a grain of salt, and you still have to have low DTI and reserves, and we have to be able to show that you've had 2 years of reestablished no late payments on anything. And that's where lenders make the exception on lending to those people.
Yeah, but that's the so. And Juan, because you are the expert in the room, we'll say, right? On a 28-month history, you're going to see a person's current financial situation. On a 7 year, what percentage is given to credit history on the FICO? Is it 30 or 35?
So let's break it down in like a minute.
Yep.
Ready?
Go ahead.
There's 5 factors to FICO 2, FICO 4, FICO 5, which is what currently is being used by every single lender in the United States. By the way, the whole using V4, Vantage 4.0 idea, that got signed and approved back in 2018. And now we're making it a thing again? Anyways. Credit utilization is 30%. Keeping your credit cards under 10% accounts for a third of your credit score. Then you have payment history. Do you not pay your bills on time? Do you not have a collection? Do you not have a repo? Well, Josh, it's not a repo. I turned the car in. Don't care. It's a repo. 35%. Payment history, 35%. 15%. Length of history. I have a credit card with Chase that's 14 years old. My length of history, therefore, is 14 years old. 10% is going to be new credit, aka hard inquiries. Okay? An inquiry will live on your credit report for 2 years, and it will be calculated into your score for only 12 months, right? You go to the dealership, and man, they shotgun your credit, they pull your credit 15 times, you're screwed, okay? So try to keep 10% is how many times are you getting your credit pulled. Based on the data that we have, we suggest you do not get your credit pulled more than 6 times a year. And the last one is going to be your credit mix or credit profile. That is, back to Jeremy's point, can you show to me that you know how to manage long-term debts, revolving debts, short-term installments, and what we know as open or other, right? So that's going to be a mortgage, an installment, a revolving account, and then an open or other, such as like an American Express self-reported type of account. That's it, man. It's 5 things. It's 5 things.
And let's put a little bit more common sense into that. The majority of the Americans are getting into 30-year fixed rate mortgages. If I'm lending, the banks are saying I am lending to this person for the next 30 years. I want a history of somebody, and data of how well they pay all of their debts and manage their credit utilization to not overextend themselves for 7 years versus 28 years. Maybe V4, if a person is going to say, okay, I want a 10-year, maybe a 15-year mortgage because they have, so much money down, or they're in a really strong financial, situation where they make, $500,000 plus a year and they can afford a C10. Maybe a lender might be like, yeah, let's use, the last 28 months because they're only going to got a 10-year mortgage. No lender on a 30-year mortgage is going to say, man, you were a jackass, or you had some serious financial hardships within the last, 7 years. But you know what? We're only going to look at the last, 28 years, because they know it typically takes 7+ years to get into an established point in your financial stabilization.
But that's the
versus a
point, though.
28.
I disagree, Jeremy. I've put several
And you
people
can.
who had,
And I'm not saying I agree with it. I don't lend the money. The Wall Street
sales within 7 years, and we were able to put them in a house within a 7-year time frame. So
you're talking about an isolated event. You're talking about an isolated event, and I think that's where you fail to capture.
You made a comment that the history is like the greatest predictor of the future, and I disagree, because
Correct.
if somebody had a short sale within 7 years, then why wouldn't you say that, there's a high probability that they're going to have another short sale because they had one already?
So
I've seen people with multiple short sales. Hold on. I have seen people with multiple short sales. I can show you credit reports today.
We still put them in house.
With Chapter 13 bankruptcies and with Chapter 7 bankruptcies, it's much, but the level of difficulty, okay, and what you're failing to even with the people. This is two different buckets: a 28-month history versus somebody with a short sale. I agree. If you had a life event like a short sale or bankruptcy, you should not be penalized your entire life for not buying a home. You should not be penalized. But there are parameters. There is no way. Take what we want, because we were all commissioned employees. Like, we want to help people too, because this is how we get paid. We want to help people, but we also want to get paid. But if you're looking at it fundamentally, if you have $1 million sitting in your savings account now, and I want $1,000 of that, and I tell you I have a short sale, and Juan goes to you and say, I want that same $500,000, and he doesn't have a short sale, whatever terms you give me are not going to be the same terms that you give Juan. It's not saying that we shouldn't. It's saying, how are you going to mitigate your risk to ensure that you're going to get that $500,000 back? Not saying that you're not looking at anything different. It's saying that there has to be compensating factor. When we're talking about short sales, bankruptcies, we're talking about life events that can be overcome when you're meeting certain factors that still fall in with their current algorithms. I'm not saying ignore them. They should be able to get homes. I'm an advocate. Yes, we need to be trying to help these people, educate them, and get them in homes by any means necessary if it's possible. But also, as a lender, just because I can get somebody pre-approved on paper, there's been many times where, being transparent, they shouldn't be buying a house, right? Like, again, if you don't have any money in the bank, and if you're struggling to come up with an EMD, if you're struggling to pay for your appraisal and your home inspection, man, the salesperson in somebody's like, yeah, I'm going to get them into a loan anyway because I can figure out how to get all this cost, covered. Buying a home is a privilege, not a right. And I don't mean to sound cruel when I say that. It is an absolute privilege to buy a house. It's not a right. No bank has an obligation, as long as they're not discriminating against you, against sex, religion, sexual orientation, anything like that. It is a right. Like, driving a car is a privilege. It's not a right. You have to show the DMV that you are cognizant of operating a motor vehicle and that you know the laws and you're going to upstate within those laws, and that you don't have any DUIs and reckless driving, on your driving record, right? Just because we can doesn't always mean we should. And I know that's a whole nother conversation in itself. But again, I want to be very clear. I just want to be very clear.
The
We
thing
can't
here
help
is, regardless if it's FICO or Vantage 4, you can have a life event post 2 years from now and within 7 years, and we're still going to give them a home loan. I don't
If
care.
it's possible, if we meet guidelines, absolutely.
You're absolutely right. And whether or not it's a Vantage with a 28 months, which is going to be a real-time trend, right, of a person's ability to pay. I mean, it would be like us saying that we can expect a football player that was a running back that did really good 7 years ago to still be doing good right now versus when it's 2 years, right? So the Fair Isaac system, it's old, it's outdated. Banks can say it's tried and true all they want, but it just doesn't meet the standard for the current American today, and that's just my point.
And that's where I can say two things can be true at the same time. Two things can be true at the same time.
Early adopters are going to be the ones that actually benefit from it. And so those people who have a dinosaur mentality,
that's why it's called
maybe
risk
like
management,
and believe in digital photography. And
it's called risk management. It's called risk management. I'm not saying that you might have, and I tell you what, because I always know how this is going to work. Because again, this has only been approved by Fannie and Freddie. FHA and VA are still gonna make us use FICO 5, 4, and 2. They're not gonna adopt.
Guys, this is
they're not gonna.
man.
They're not gonna adopt Vantage 4.
It got approved in 2018. This is not new. Also, Josh, I
think it is going to approve. There's a bill right now on the floor that just passed yesterday with a 24 bipartisan vote. A road, which me and Robert are going to do a separate episode on it separately from this right here, but it is going to happen. Because
that's why Vantage is being brought back up again.
It is absolutely going to happen.
Right.
You watch it. It might take 5 years for it to roll out to the masses, but it is going to happen because there is a huge push to get people in homes. There's a 4.5 million, the 6 million, depending on who you speak to, home shortage. This bill is going to help facilitate the funding in order to build more homes, the manufactured homes. In fact, it even talked about rolling out manufactured homes, and mobile homes as things that lenders, you, Jeremy, are going to start loaning on. And right now, we all know that you got to use like a chattel loan to get those things.
Yeah, Josh, let's do this again in 1 year. And then we'll have enough data.
We absolutely could do it again in a year. We could do it every year until it rolls out.
We'll see,
but
right?
I'm telling you, there are going to be people who adopt it.
No, and here's the thing,
there will be.
But that's why my dad has this beautiful saying: pioneers get arrows in their back. So.
Not always. We've seen what happened with digital photography. Kodak, they sat back on their laurels and they're out of business. They're extinct.
Yeah,
they didn't think that digital photography was the way. There's a whole bunch of businesses that failed to innovate. There's a whole bunch of them. I just heard yesterday.
We're not talking about innovation. I just think we're talking about
this is innovation in the trend of how Americans spend and borrow money. That's how I look at Vantage 4.
So let's talk about
the only constant in our industry has changed. The only constant in our industry has changed. And there's going to be cycles. There's going to be cycles of peaks when everything's going good and rates are low and more people are in the market. You're going to take more risk because volumes solves everything, right? In a and this is another at bat for quote unquote the government to try and make it easier to create more stimulus in home buying activity, to make it easier because they want more people to buy homes. So, and again, from a pocket perspective, does my wallet want everybody to have a 700 FICO score? Sure. That's not going to change a DTI perspective because now we've overcome the credit issue. But with $1.32 trillion in credit card debt and the average payment being over $500 per month for an auto note and student loan, we still have an affordability crisis with homes being stabilized. And guess what? Those rates go down. Those prices are still going to go up because you're going to have more entry into the market.
Not. The prices will go down because the money is going to be allocated in order to increase spending. So this is simple supply and demand, right?
Wait a minute. So when COVID happened and rates were 2 and 3%, there wasn't enough supply. Right now, there's not enough supply.
There wasn't enough supply. There has never been enough supply since the 70s. Like they stopped mass building in the 70s. So
You don't
there's
think
never been
prices will
enough supply.
increase though?
In
You
fact,
don't
what
think
happened
prices?
was, and we've already talked about this, after the financial crisis of 2008, the federal government pulled funding from the federal building fund, which they used to build federal housing projects in order to help bail out the banks who gave out the bad
So
loans, who didn't do their
when
own
there's
research. But
when there's
then they
less
said, we're not
inventory of
going to
something,
need that
economics
money.
101, when there's less inventory of something, do prices go up or do prices go down?
Yeah, that's
Prices
why
go
prices
up
have
when
been up. That's why
as
they've
long as
been
the
up.
demand is there.
Yeah,
Okay,
they've been up.
okay, but so
The
then
supply is about to be high because they're
when
going to
is the
help. What? That's what the
so,
road
so
bill that's on the table right now that just passed
no,
with a 24-0 bipartisan vote in,
Yeah,
this,
but no,
in the
but,
House of Representatives.
but the point, I think that the point that we're missing here is that Vantage 4.0, the House Bill 2808, whatever you want to bring up, is it going to change the credit scoring model? Sure. Is it going to be applied? Agree to disagree. Is it going to be long lasting? Also agree to disagree. None of this is addressing the thing that Robert brought up that nobody talked about, which is consumer spending. It is not going to fix DTI. It is not going to change levels of income, right? And to Robert's
inflation
point
rates,
earlier,
that's not
and we
keeping
went
up
right
income
over
with
it, right?
inflation
Because it's
rates.
kind of easy to just let it go. This spending, we are at $1.32 trillion. When I met Jeremy Barrios in Florida 6-7 months ago, we only owe 1.28. And when I did a podcast back in August of 2024 with Mark Jones, we only owed 1.12. They can't stop us from spending, okay? And the people that can't get a credit card, we found a way to give them a digital one with buy now, pay laters, right? We reversed the concept of layaway. I want something that I cannot afford. I'm going to leave it here, and I'm going to pay and pay and pay and pay until I've been able to pay for this, and now it's mine. A lot of people here are not going to remember Kmart and layaway or what the heck it was.
Oh,
That's
yeah.
what it
We remember it.
Yeah.
Cool. What are we doing now? I'm going to go on Amazon and I'm going to buy myself a espresso machine for $620 that I can't not afford. Okay? It is not part of my budget. But I'm going to click a button instead of saying pay with my credit card. Pull up Amazon right now. I'm going to click a button that says I'm going to buy it now and pay later in 7 easy installments, okay, at a 27% interest rate. Oh, no, but they offer 0% financing. Sure, but you have a monthly fee. So what is that? We just found a way to give people with a 400 credit score a way to finance things online. Look up, and you guys got YouTube pulled or Google pulled up. Google Klarna Burrito Loans. Klarna Burrito Loans. Klarna, since January, I brought it up earlier, $136 billion that have not been paid back because Americans keep buying things that they can afford to impress people that don't matter. How are you going to fix that? I don't care what algorithm you throw, right? That's the issue. We don't have money to be able, let's just say prices go down. Let's just imagine prices go down. We still don't have the money because we're spending it on crap we don't need. Like that's what nobody's thinking. Like, I don't care what algorithm you throw to change credit scoring models. More power to them. Is it old? Yes. Does it suck? Yes. Does it address today's consumer? No. Because it's from back
No,
in the
it's part of culture, American culture, to consumerism, I guess. And they can debate that philosophy over and over again, and we'll probably get nowhere on it.
No, like it, but the point that I'm trying to make, right, is that I now have the ability to order lunch for my team, and instead of paying right now, I can push a pink button with a black K inside of it and make bi-weekly payments of $7 on a $75 lunch. And
Yeah.
people are doing it. It's getting adopted faster than anything. It's getting adopted faster than the use of ChatGPT.
Yeah. I mean, and that's where, it's interesting that they're coming out with ways in which people with even very low credit scores can have installment loans.
They don't run your
On
credit.
every day.
It's very
Yeah,
simple. But it's not going to run your credit.
So, but does Vantage with that, because just more and more people are going to maybe take on more debt, and now student loan borrowers, those that have been kind of on pause, they have to come in and now they have to pay their loans. They might have got a letter from the federal government saying you will pay your loans. So that's going to have an issue too. I just think that when we talk about Vantage, it just seems like the adaptable credit scoring model to fit the current, snapshot of the average American person. Because at some point, if you just want people with pristine credit scores, don't have a lot of debt, have a lot of income, with a high, I'm going to say high inflation that we got right now, because we're still close to 7% interest rates, and that's not going to go down unless we have 2% inflation, which whatever, that's another discussion. But I don't know. I just see I kind of agree with Josh in the sense that Vantage could be that scoring model in the future to where it can help. Because I don't know necessarily even what Jeremy said, judge by past to indicate the future. 2 years ago,
we also said that we wanted to work. Like,
Yeah.
do I want this project that we're pointing out there to work? Yes. I want people that did have a tragic event occur 4 years ago to be able to get a house. I want people to not be judged in the fact that I tried to help my cousin buy a car and he didn't pay the car on time 3 years ago. I want that to go away. I want it to work. But I don't think it's going to, just because of what Jeremy brought up at the very beginning of this entire show. There's a lack of education. Nobody's teaching us how to manage or even how to leverage credit, because we haven't even talked about leveraging. But I want it to work, right? Like, I want it to work. I can tell you, I talk to loan officers nationwide every day, all day. I've not stopped getting this question about Vantage 4.0, and nobody's told me, JP, I just did my first V4 pre-approval. When I get that, you'll be the first one I'll call. And I'm
Coming. If there's any loan officers out there that did a V4, just drop it in the comments down there so that way JP can see his first
next time I'm
one.
in Virginia Beach, I'm paying for lunch, dinner, whatever, and Jeremy will pay for the champagne for you. You'll pay for it. All right?
That's a deal. That's a deal. That's a deal.
All right, real quick.
I do wanna
Hey,
bring up-
JP, I know we've been going really long here, and you are our featured guest here today. So real quick, can you just give us a little bit of a snapshot on UQAL and how it can help real estate agents and professionals in the real estate industry with, our daily job real quick?
Yeah, the biggest thing for you as a professional is not only taking those clients that, again, can't qualify right now for whatever reason, whether it's financial and credit, and get them across the finish line. I think that one of the biggest benefits as a partner that you all get is the content that we're putting out, right? We're keeping people at the very forefront of what's happening. So we just did an entire 3-part series on the potential increase on the cost of credit reports, right? Since last year, credit reports have gone up 260%. Right?
Wow.
They're getting super expensive because there's a potential of the elimination of something called trigger leads. You get your credit report pulled, and then a bunch of people are calling you and harassing your clients. It's wild. They also just put out an entire article about what happened with the student loans, right? Why are 9.7 million Americans getting affected by this? A lot of them had no clue. We also are doing a ton of content on literally what we're discussing for the last half hour, this Vantage 4.0 and all of that. So why am I bringing up the fact that I have probably the most incredible marketing team serving my referral partners? It's because I want them to rip us off, right? Picasso said, I can only see so far because I stand on the shoulders of giants. For me, it's like, take my content and put it on your social media, because at least I know that you're not blabbering from TikTok University, like Jeremy likes to call it, right? I know that you're giving out good information.
University of Facebook, PhD from TikTok.
PhD. The other one is the partnership between the real estate agent, between the loan officer, between the loan readiness experts here and the client, right? Communication closes loans. So if we, instead of you selling somebody, hey, good luck, go fix your credit, come back in 6-8 months, putting them into a team, into an ecosystem, designed specifically for them to have one goal and one goal in mind. I want to be a homeowner. Okay. I want generational wealth for my family, for my kids. That's what, outside of the sarcasm and me making fun of the algorithm, blah, 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 like, it's cool to come to work because I know that every time my team does their job, we're changing people's lives, man, and people take that for granted, you know? We can go down rabbit holes about algorithms and blah, blah, blah. At the end of the day, like, how blessed are we that we get paid by helping people change their future, financial future, right? Yeah. So that's what UQAL does, man. We're here to literally take those people that otherwise, because anybody can do a 40% DTI 720, but who's going to be the group? Who's going to be the team? The Josh and the Jeremy Barrios that are going to take that 560, right, with a 57% DTI and give them the tools necessary, aka UQAL, in order to get to where they need to be. And not only that, man, as you're going through this process, to be able to educate people so that this type of conversation should be happening a lot more, in my opinion. Whether you two want to yell at each other or not, that's fine.
We might yell at each other after this is over.
It's all good. I appreciate you guys having us on.
Yeah.
All right. Well, you got anything else, Joshua?
No, I'm good. Thanks.
All right. All right. Again, subscribe, like, leave a comment below. Thanks for watching. See you soon.